This company has $99 billion in signed contracts. That's 8 times its entire annual revenue booked in advance from names like Meta, Microsoft, and OpenAI. It's also losing money every single quarter, drowning in debt, and its stock has fallen almost 50%. Meet CoreWeave, the most extreme bet in the entire artificial intelligence boom. CoreWeave rents out the raw computing power that trains and runs AI. It went public last year at $40 a share, rocketed to over $160, and now sits around $70. So the question is simple and huge. Is this the smartest way to own the AI boom, the picks and shovels of the whole gold rush? Or is it a debt bomb with a countdown timer? The answer comes down to one number. Stick around, because Part 3 is where most people get CoreWeave completely wrong. CoreWeave is a $43 billion company, and its revenue is on track to roughly double this year to $12 or $13 billion. We'll run this in 3 parts: the bull case, the ticking clock underneath it, and the chart. Then a verdict, and the one metric that settles it. Let's start with why the believers are so loud. 1. The growth is almost unreal. Last quarter revenue more than doubled, up 112% to $2 billion. And management expects revenue to roughly double again this year. 2. The backlog. This is the headline. CoreWeave has $99 billion in remaining contracts, up from $26 billion just a year earlier. Meta signed a $21 billion deal. OpenAI, more than $22 billion. Demand is not the question here. The demand is staggering. 3. Even Wall Street, after the crash, sees upside. The average analyst price target sits around $140, roughly double today's price. The most bullish target on the street is $250, revenue doubling, a $100 billion backlog, and a stock that just got cut in half. So what could possibly go wrong? Here's the ticking clock. Every bit of that growth was bought with borrowed money. To build the data centers behind those contracts, CoreWeave has taken on a mountain of debt. Its total liabilities have climbed past $50 billion against less than $5 billion of shareholder equity. Just the interest on that debt is running around $700 million in a single quarter, and the company is not yet profitable. Last quarter, it posted a $740 million net loss. It is spending enormously today for revenue that arrives over years. Then there's the concentration risk, and it's a big one. Around 45% of CoreWeave's revenue comes from a single customer. It leans heavily on Microsoft and, ultimately, OpenAI, and every server it runs depends on NVIDIA chips. If any one of those relationships changes, the whole model feels it. So the fear, in one sentence, a $99 billion backlog is only worth something if CoreWeave can survive long enough and stay funded long enough to actually deliver it. So here's the scorecard. On one side, explosive triple-digit growth, a $100 billion backlog, and the deepest ties in AI infrastructure. On the other, a mountain of debt, quarterly losses, brutal customer concentration, and total dependence on NVIDIA, generational opportunity, or house of cards. For a tiebreaker, we go to the chart. Fundamentals tell you what, technicals tell you when, and CoreWeave's chart is a warning sign. From an all-time high near $164, the stock has collapsed to around $70, sitting close to its 52-week low of about $64. It trades below every major moving average. That is, technically, a strong downtrend. Momentum is mixed. The relative strength index sits around 50, right in the middle, neither oversold nor overbought, while the trend indicators still flash sell. The levels that matter. Support is right underneath, at the 52-week low near $64, and below that, the $40 level where it first went public. Lose those, and there's little history to catch it. Overhead resistance sits up near $95 to $100, where the falling averages are waiting. So the chart says, a broken down trend, sitting near its lows, extremely volatile, waiting for proof. So, generational opportunity or house of cards? Here's the honest framework. The bull case is real. Somebody has to build the physical backbone of artificial intelligence, and CoreWeave has a $99 billion head start, with the biggest names in tech signing the checks. If the AI build-out keeps going, this beaten-down price could look like a gift, but the bear case is just as real, and it's brutal in its simplicity. CoreWeave is in a race between its revenue and its debt. It must turn that backlog into cash faster than the interest payments and losses drain it. Which brings us to the one metric that settles the entire debate: free cash flow. Right now, it's deeply negative. The quarter CoreWeave's free cash flow turns positive, proving the backlog is finally converting into more cash than the debt costs. That is the moment the bull case is winning. Until that happens, every new contract is also a new pile of borrowing. Pair a turn to positive free cash flow with a breakback above that $100 level, and the believers have their proof. Until then, CoreWeave is the purest, highest-stakes bet on the entire AI boom, enormous upside if it works, and very real danger if the money runs out first. A stock to understand completely before you ever touch it. That's the full breakdown, the backlog, the debt, the risks, and the why behind all of it. If this helped CoreWeave make sense, subscribe. Every week we break down one company on Wall Street exactly like this, so you can invest with a framework instead of a feeling. The free breakdown sheet, with all the numbers, is linked in the description. Quick but important. This channel is for education and analysis only. It is not financial advice, and I'm not your financial advisor. Do your own research or talk to a licensed professional before investing a single dollar. What company should we break down next? Drop the ticker in the comments. See you in the next one.